Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, the last few weeks in the stock market have not been for the faint-hearted. Not only has the volatility been very high, the wealth destruction in some of the popular names has also been massive, to say the least. Just to put things in perspective, I got a WhatsApp message the other day which said that the likes of Zomato, Paytm, Nykaa and PB Fintech raised rupees 39,000 crores jointly from their IPOs. Let me repeat that. These four companies raised rupees 39,000 crores combined, and guess what the wealth destruction has been? Well, cumulatively, they have eroded 2.2 lakh crores worth of investor wealth. Yes, you've heard that correct. They raised 39,000 crores combined and eroded more than 2 lakh crore worth of investor wealth. It is the unsuspecting retail investor who has had to bear the brunt of a large part of this wealth destruction. Now, to be fair though, these are not the only companies that have seen huge wealth destruction. Most stocks that either had poor fundamentals or lofty valuations have been at the receiving end of this correction the most. Speaking of correction, I'm sure everyone is keen to find out how long this correction is going to last. Has the market bottomed out, or is there more pain to come? To be honest, while there have been individual stocks that have corrected a great deal, the broader market, say the Sensex, hasn't corrected that much. It is down only about 8% from the top and is not even halfway through the start of a bear market, which is technically defined as a minimum 20% correction from the top. So officially, a bear market will start once the Sensex goes below the 50,000 mark in the near term. Therefore, I am of the view that value investors should start getting interested in buying more stocks once the Sensex falls below 50,000 and not right now. Since the broader market correction hasn't been that deep, they should stick to the current strategy in my opinion. Now, please note that value investors behave differently in the stock market than, say, technical analysts or even momentum investors. Value investors believe in the philosophy of buy low and sell high, which is why the lower the market goes, the more they will be interested in buying, and higher the market goes, the more they would like to sell. Technical analysts or momentum investors, on the other hand, are usually trend followers. They believe in the philosophy of buying something that's going higher and getting out of stocks that are trending lower. Therefore, while value investors buy low and sell high, technical analysts or momentum investors buy high and sell low. Now, since this video is about value investing, we will stick to the strategy of buy low and sell high. Theoretically, a value investor will make the most money when he invests at the lowest possible price and sells at the highest possible price. Therefore, his goal in life should be to identify the lowest low of a bear market and the highest high of a bull market. Now, as we are talking about a stock market correction, let us see if it is possible to find out a bear market low so that a value investor can use it to take a huge exposure to stocks and earn market-beating returns over the long term. Take a look at this table. This table has the details of all the bear markets that have occurred in the Indian stock market since 1990. So over the last 31 years or so, there have been 10 bear markets where the markets have corrected 20% or more. This table gives you the date-wise occurrence of the different bear markets, starting all the way from October 1990 to Jan 2020. The closest were the ones between Jan 2008 and November 2010, where we had 2 bear markets in less than 2 years. The farthest were the ones at the bottom of your screen, where the first one started in Jan 2015, while the second one came almost 5 years later in January 2020. where the coronavirus had the entire world in its vice-like grip. Well, the takeaway from this slide is simple. Although there is a bear market every few years, it does not happen with any degree of regularity. At times, there is a gap of less than 2 years between two bear markets, while on other occasions, the gap can be as high as 5 years. Okay, what about the percentage fall from the top? Does the market fall a fixed percentage point in every bear market, or is there a significant disparity here as well? Well, the answer lies on this slide. I have arranged all the bear markets over the last 3 decades based on the biggest to the smallest decline from the top. As you can see, the biggest bear market started in Jan 2008 and ended in March 2009, and the Sensex corrected a massive 61% from its top. As I highlighted earlier, a bear market is defined as a minimum correction of 20% from the top. But here, the correction was a huge 61%, which meant that this bear market was thrice as devastating as a normal bear market. The second biggest bear market was also quite devastating, with the market going down by more than 56% and lasting a total of 588 days. Therefore, the most ferocious bear market was a fall of 61%, while the least ferocious were the ones at the bottom of the screen, where the markets corrected by 23% and 27%. Again, the takeaway is pretty simple. There is no clear pattern across different bear markets of the last 30 years. While at times markets have corrected as much as 61%, on other occasions the fall has been just 23%, and the markets have recovered quickly after that. Now let us see whether there is any predictability in terms of the total duration of a typical bear market. This slide will help us with the answer. Again, no clear trend emerges. The total duration of the bear market has varied from as short as 1 month and 5 days back in May 2006 to as long as 2 years and 3 months further back in September 1994. The coronavirus-induced bear market back in January 2020 was also one of the shortest, lasting all of 2 months and 9 days before the market staging a remarkable recovery. Hence, here also no clear trend is emerging. It is very difficult, in fact almost impossible, to figure out how long will a certain bear market last. It could be as low as 1 month and as high as 2 years. Here are the key takeaways from the 3 slides once more. Although there have been 10 bear markets over the last 3 decades, knowing the start date and end date in advance is impossible. The magnitude of the fall has varied widely, falling up to as much as 61% in one instance and just 23% in another. The total duration of the bear market has also fluctuated a great deal over the last 3 decades, from being as short as just 1 month to being as high as 2 years. So there you are, trying to understand the anatomy of the great Indian bear market. Well, fair to say that we have not been able to make heads or tails of it. The Indian bear market is too complex a beast to understand. Now, Warren Buffett has a very famous saying which goes something like this: predicting rains does not count, building arcs does. I will rephrase that. Don't try to predict the rains. Instead, try building arcs that will protect you against the heaviest rains. Well, the first part of Buffett's phrase is easy to understand. He has equated a big bear market with rainfall. And as we saw with those 3 slides, there is no way anyone can predict when a bear market is going to strike. What about building the arcs? How do we do that? Well, I recommend my subscribers to be at least 25% in cash or fixed deposits at all times. And I also recommend them to keep taking the cash exposure higher as the markets keep going up and lower as the markets keep falling. For example, right now, I have recommended them to be 50% in fixed deposits and only 50% in stocks. Now I will gradually start reducing the fixed deposit exposure to below 50% when we enter a bear market. So once the Sensex falls below 50,000, I will start taking the exposure to stock higher and to fixed deposit lower. Say at 50,000 Sensex, I will maybe take the stock exposure higher to 55% or 60% and then gradually keep increasing exposure after every 10 to 15% fall in the market. Now, since we don't know by how much the markets will correct in a bear market and how long will the bear market last, it is always better to adjust your exposure in a phased manner. You gradually start taking more exposure to stocks as the markets keep falling beyond 20% and gradually reduce exposure, say after every 25 to 30% rise in the market. I'm sure you're wondering, why do all these numerical gymnastics when you can stay 100% invested and take advantage of the long-term India growth story? You are right. However, my goal for my subscribers is to beat the benchmark index over the long term. And in order to achieve this, I will have to try and do things differently than the crowd. I will have to be fearful when others are greedy, that is, reduce exposure when markets have gone up a great deal, and I will have to be greedy when others are fearful, that is, increase exposure after they have fallen a great deal. Is success guaranteed here? I don't think so. There is no strategy in the market where success is guaranteed. But this strategy allows me to do the right thing, that is, increase exposure when markets are down and reduce exposure when markets go up. And this is all that matters over the long term. I have seen so many people do the exact opposite, that is, reduce exposure after markets have gone down a lot and increase exposure after they have gone up a great deal. And this is the number one reason they end up underperforming. So to go back to the original question, is the market correction over? Well, I don't care, to be honest. All I know is I will be a buyer when the Sensex starts going below 50,000. But right now, I'm staying put with my current allocation. Do let me know with your comments and views on what you think of this approach. Also, if you want to know about this strategy in more detail, then you can grab my Lazy Millionaire learning course at a big discount. In the course, I reveal all the secrets about how I earned market-beating returns for my subscribers using the strategy I just highlighted. It involves no detailed financial spreadsheets, no sector analysis, and no study of the economy. It's about a few simple rules and principles and having the discipline to stick to them at all times. So do click on the link in the description box for more details. Goodbye and take care.